Ever wondered how life insurance could double as an investment? Wow, that's right. Indexed Universal Life Insurance or IUL offers not only lifelong coverage but also a way to accumulate cash value linked to the stock market. Imagine having the potential to grow your policy's cash value while being shielded from market downturns. But oops, there are some catches you need to know before you dive in. Let's explore the pros and cons of Indexed Universal Life Insurance and see if it's the right choice for your financial future. Indexed Universal Life Insurance or IUL is a type of permanent life insurance that stays in effect as long as you continue paying your premiums or until the policy's maturity date, which is typically when the insured reaches at the age of 121. What sets IUL apart from other types of universal life insurance is how its cash value accumulates. The cash value is tied to the performance of an index like the S&P 500 or Nasdaq Composite, giving policyholders the potential to benefit from market gains. However, it's important to note that the insurance company doesn't actually invest in these indices. Instead, the index's performance is used to determine how much interest is credited to your cash value. Here's where things get interesting. If the index performs well, your cash value grows. If it drops, your cash value is protected by a floor, often 0%, which means your account won't lose money during a downturn. Wow, that's a relief. However, there's a cap on how much you can earn from the market's performance. For example, if your policy's cap is set at 10% and the index rises by 12%, you'll only get 10% growth in your cash value. But where's the catch? Well, your cash value doesn't mirror the index exactly due to limits like participation rates. The participation rate is the percentage of the index return that is credited to your account. This can range from 25% to over 100% depending on your policy. If the participation rate is 50% and the index grows by 10%, you'll only see 5% growth. Even though the growth is calculated monthly or annually, the interest is usually credited to your account once a year or every few years, depending on your segment period. IUL policies offer flexibility in terms of premiums and death benefits. If your cash value has accumulated enough, you can use it to pay your premiums. But ouch! If the index performs poorly and your cash value decreases due to policy charges, the insurance company could issue a premium call, meaning you'll need to pay more to keep the policy active. If your policy lapses, you could lose not just the cash value but also the death benefit. Borrowing against your IUL's cash value is another interesting feature. You can take out a policy loan or make a withdrawal, but any amount not repaid will reduce the death benefit. And remember, the death benefit is paid tax-free to your beneficiaries upon your passing. However, if your policy matures and you're still alive, some policies only pay out the cash surrender value, which could be as low as $1 in extreme cases. That's a scenario you definitely want to avoid. Now, let's talk taxes. With an IUL, you can withdraw up to the amount you've paid into the policy, known as your basis, tax-free. But any withdrawal beyond that, especially from your investment gains, could be taxed as income. Similarly, if you borrow against your cash value and let the loan interest deplete your account, your policy could lapse, triggering taxes on the outstanding loan balance. So, is IUL a good investment for you? Well, it depends on your financial goals. If you've maxed out your retirement accounts like a 401k or IRA, IUL offers a way to grow your savings tax deferred and without contribution limits. It's also ideal for people looking for market growth with downside protection. But be prepared for higher premiums and fees, including administrative expenses, commissions, and surrender charges. In short, indexed universal life insurance can be a great way to participate in market gains while securing a death benefit for your loved ones, but it comes with risks. you need to actively manage your policy and understand the impact of caps, floors, and participation rates. So, before diving in, it's crucial to work with a financial advisor or an experienced life insurance agent who can guide you through the complexities of IUL and help determine if it's the right choice for your longer-term financial plan. Subscribe to Solitaire Investment channel for similar financial advices. That's all for today.